Mark, thanks very much for joining us here in Frankfurt. Obviously, a lot of changes in the last 3 months. What's your sense, I suppose, of where we are, and particularly some of those macro impacts in terms of the real estate financing side and investment side?
You're right. Things have changed quite a bit over the last couple of years. It actually started last year already. Mid last year, inflation began to go up. There was talk of interest rates getting higher. Didn't really happen then. But now that we're talking inflation rates of 7 to 8%, and the Fed is moving already with interest rates getting higher, I think we can expect interest rates in Europe to be raised 2 times this year, maybe even 3 times this year. So the entire interest rate spectrum will go up this year and also next.
And what's your sense, I suppose, of the potential impact there and influence on the real estate markets and the debt markets?
Well, on real estate, there are elements of inflation hedge within real estate, as many of the leases are indexed to inflation. Of course, you have other aspects coming into play. As there is inflation, people have less disposable income, so they have less money to spend on retail, less money to spend in hotels and in restaurants. So there's pros and cons on this. In terms of debt finance, I don't think there's a big shift there. There's still a lot of demand from investors in terms of investing into real estate, and they need debt finance. And they typically there's a partnership between the big banks, the banking lenders, and alternative lenders. So I think there's not a huge change in this. While there might be some slowdown in terms of investment activity towards the second half of this year, I think in the longer run it will return, as there's still pent-up demand for real estate investments in general.
Great, really interesting to catch up. Thanks for joining us, Mark.
Sure, you're welcome.